Good afternoon. This is Stephen Leeb with a market update for Thursday afternoon. Coming to you from Leeb, Leeb.com, where we offer free market research and free information if you just sign up at our website. Today's market action was really kind of a mixed bag. Market started off with a very, very strong bid. Prices looked like they really wanted to move higher, but by the end of the day, we think the bears probably had a little bit more control, though the bulls did hang on and the market did finish with a small gain. What stood out to us, at least in the news background as well as in market action today, was the strength in commodities. Particularly oil came back, and some of the aggressive oil companies, not the Chevrons and the Exxons of the world, which are those companies you want to own if you really believe things are terrible, but the oil service companies were strong today, as they were yesterday, even in the face of declining oil prices. Oil prices today did bounce, and they bounced, we think, on the back of some stunning news from China. Auto sales were up over 40% year over year. And China now, clearly, not by a small margin, but by a large margin, leads the United States in terms of automobile production. That is a remarkable fact. If you think back 10 years ago, if someone told you that 10 years ago, you would have called out the white coats and had that person institutionalized. It would have been such a weird, almost psychotic thing to say. But here we are in 2009. And China is by quite a margin the world's largest automotive producer. Given IMF's recent predictions that emerging economies led by China are going to grow by 4.6% next year, and sometime in the fairly early part of the next decade exceed the developed world in terms of importance to the world's economy, we think that the run in commodity prices is probably justified and will probably continue, albeit with many, many ups and downs for the foreseeable future. This is not good for stocks, it's not good for defensive stocks, but it will be good for commodity-oriented stocks, it will be good for gold. So for the market, we continue to advise caution, we continue to believe there is more downside than upside, but for commodities, we think the odds are tilted a little bit in the opposite direction. So that's where we suggest you continue to put your money. Have a very nice day. Thank you very much.